Good Friday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the shared disclaimer and be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show is for informational purposes only concerning Market Chameleon tools and products. With that, good morning, D.
Good morning, Will. How are you?
Good.
Let me share my screen here. And good morning, everyone. As I'm doing this, a quick note, if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into that live chat on YouTube. Will's keeping an eye on it. He'll let me know and read it back to me. And to give you a couple minutes to put those questions in, we're going to start out taking a look at our pre-market report to see what type of insights we could get in the pre-market hours, and then we will move on to our questions. So let's start out with the pre-market report. Up top here, you will notice a calendar view, and this also shows some summary statistics, what occurred in the pre-market hours on those dates. The idea there is to compare today's activity to the most recent history to see if you could spot something unusual or trend. So let's cover today's activity, and that's where we are here, August 9th. As you can see, we have 475 stocks trading higher in the pre-market, 373 stocks trading lower, got 248 million shares trading on up volume, 76 million on down volume, and we have $2.6 billion worth of stock trading higher. However, we do have $4 billion worth of stock trading lower. So that kind of shows a mixed bag of what may be going on in the pre-market. Nothing points definitively that we're super bullish or bearish. Let's take a look at it from a couple more perspectives. Then we will move on to our questions. So I'm going to slide down the page. And as you can see here, we have a more granular view of the trading activity in pre-market. We see stock symbols, stock prices, price changes, volume, and we also have our most active stocks, the biggest percentage gainers and biggest percentage decliners in a pre-market. And here we see 76 stocks made it onto our largest percentage gainers list, 72 on our largest decliners. So that also just shows that things in a pre-market look pretty balanced, mixed bag. Now, to make it onto this list, we do set thresholds in place because the stocks in a pre-market could have low volume, low liquidity. And if it meets our thresholds, we'll put it on, it will make it onto this list, and that will include small cap stocks. It could include ETFs. It could be closed-end fund, could be a leveraged ETF, or even an inverse ETF. So to narrow down our list further, we could use our filters above. This filter here, you'll see it on a lot of our screeners or reports. It allows you to screen out this report by stocks that you saved in the watch list. So if you have a watch list and you track a certain group of stocks, you can screen this report by your watch list. We're going to use this filter in ETF in our example, which is similar concept. However, I'll click on it to show you what's going on here. When you click on it, you'll see there are different ETFs that you could select from. And when you choose one of them, let's go with the top one, SPY, the report below will get filtered by stocks that are holdings in that ETF. So yes, SPY, that's the S&P 500 ETF. And now we're looking at the S&P 500 constituents. So the idea there is if you have like a watch list of S&P 500 companies. And as you can see, we filtered these out, and we have 7 stocks that made it onto our biggest percentage gainers list, 4 on the decliners. So maybe slightly bullish from that perspective, but again, it's kind of a mixed bag so far in the pre-market hours. Um, and well, we gave it a couple minutes. If you have a question, I'll take it now.
Things popped in yet, D.
Okay. Um, so let me take a look at where do we stop at yesterday? Let's go to SPY. Just go there by default. And let's see. I think we talked about the single leg dashboard. So maybe what we could
I think
talk about.
yesterday we were talking about the multi-leg.
Okay, so the multi-leg. So let's just continue maybe talking about the multi-leg trades for a particular stock, and we'll just look at the SPY multi-leg trades over here. And what I did was, I went to SPY, I went under options, you could see multi-leg trades here. So I'm going to close this menu to kind of expand here. And here, what we're doing is looking at option trades in SPY that were part of a multi-leg trade. Okay, so we talked yesterday where option trades get reported on the Oprah feed. And then we have all these trades, but some of them are tagged multi-leg, meaning they're part of a complex order. And when that happens, well, this trade was not just a, buy a call or put. It had another leg to it. Could be one leg, it could be two, it could be three. So that part, the Oprah feed doesn't tell you. It gives us some information, but not all. So the Oprah feed won't tell you, like, here's a call spread, that somebody bought from a dealer, or here's a put spread, or here's a butterfly. They don't tell us that. Unfortunately, we don't have that type of information. Okay, so what can we do? Well, we could take those trades and piece them together to see what is the most likely strategy, given the information that we have, right? So what is this? So if we have two trades, part of multi-leg trade happened in the same exchange, same time, in the same expiration, different strikes, well, that looks like, call spread, put spread. And so that's the idea there. And of course, doing it by hand would be too cumbersome. You'll never be able to go through all the trades and figure it out by hand manually. So we have this software to help us do that. Okay. And that makes it the interpretation for us. So now, now that we have this data, we could just analyze it further and just get an idea of how people were using options in SPY regarding multi-leg trades. And here up top, we have this filter that we could use. And the filter itself looks almost like a report, because besides filtering out the different strategies that we detected, right? It tells us here there are 78 different types of strategies that we detected yesterday in SPY. Click on it, we could see, put spread, call spread, ratio spread. So call butterfly. There are a lot of different strategies yesterday that we detected people used to enter an order, with a multi-leg or complex order contingency. And SPY is a popular product, so it's not that surprising that there are lots of different strategies in there. These are the ones that our system, detected and interpreted. And we could filter out the put spreads, call spreads, but before we do that, let's just take a look what else this report tells us. That put spreads, this is sorted by volume. That was the most popular spread by option contracts. So that had more option contracts involved in put spreads than any other of these strategies that we have listed. 313 I'm sorry, 317,310. You could see call spreads, 259,318. What about the different combinations? So that's just all put spreads. But we know that a put spread, it's not like a stock SPY, right? A put spread could have different combinations. We could have put spreads that are in the front month, the put spreads that are in a different expiration, going longer term. So first of all, we know that there are put spreads that people could trade on different expirations. We also know that within the expiration, you could have a put spread with different strikes. You could have a strike, 500, 510, or, 490, 480. Like there are different strikes there. So when we look at this volume, 317,000, how many different, spreads traded, how many different combinations, because it could be just one trade, it could be different trades and different expirations, different strikes. So this here tells us the unique combinations, number of unique combinations, 2,614. So just that alone is letting us know that even within the put spreads, people were using, that strategy, with many different combinations, right? And it wasn't just like everybody was looking at one particular put spread. It had to be lots of different put spreads, different opinions, different strikes and different expirations. And if we click on this, if I just click on the put spread, you could see here now all the put spreads are in here. I have 2,600, and these are sorted. We could tab through over here, but these are sorted by highest volume. So let's look at this line up here. It says from 11:13:04 a.m. That was the first time we detected a trade in this put spread. And the last one was 2:53:47. That was the last time yesterday that we detected a trade in this put spread. That shows us that it had to trade at least more than one time, because just the range, from the first to the last, you could see are hours apart. The number of contracts was 38,026. The number of times it traded was 7. So we detected 7 different times that this put spread traded yesterday. This one, it was the September 20th expiration. And this shows us the days to expiration, 43. So you could see here that you can do that obviously in your head if you know, but for convenience, we just show it here. The idea there is if you expand it and you look at them, if you're looking or sorting, it's easy to just spot it by days to expiration. Here's a 0 DT, here's a longer term, 162 days, and so forth. So that's September 20th expiration. And it's easy to tell that there are different expirations. People were trading. Okay. Also, this one involved the 501, 493 strikes. And how far apart these strikes are? Well, just for convenience, we put it over here, $8 apart, right? Obviously, you could do that in your head, but if you're looking for strikes for spreads that may be traded that are closer together, it's just easier like this, right? Just to scan and say, here's one strike apart, 526, 527. Or if you're looking for wider strikes, maybe that interests you, the trades in wider strikes, you could look at, and here's $30 apart, here's $30 apart. So that's the idea behind these two columns, right? That you could just scan quickly and look for either longer term or shorter term. We could sort it by that, or strikes that are closer apart, further apart. You could sort it by that. Now we want to say, okay, we see that this is this September 493,501. So the next question is, okay, well, where's this trading around? Is it trading like around closer to $8, closer to penny? Like where are these options kind of trading? Right? Where's this spread trading? Because it could be worth as much as $8 or worthless, right? So where people trade, what are the prices people are trading this particular spread? So that's where, now keep in mind, it traded 7 different times, right? So it's not one spread, traded 7 times. So there were potentially 7 different prices. We could open it up and look at it, but we're trying to get, in essence, where has this, traded? And one way to do that is take the volume weighted average price. Volume weighted average price, we'll look at the price, something traded multiplied by the volume, the number of contracts. And then it'll do that for each trade, and then divide it all by the volume, right? So you get the volume weighted average price, where the bulk of it is trading. So that is $1.27. So now we have an idea around where these prices have been trading. And then you might ask yourself, okay, that's $1.27, but where did the price trade relative to the dealer markets at that time? So the dealer markets are where the dealers are displaying, prices that they are willing to buy this strategy, this spread, and prices they're willing to sell it. And when I say displayed, those are orders, limit orders that are displayed and firm, at the time of the trade. Firm meaning that if they're displayed and somebody tries to trade on those markets, then the other side is obligated to trade at that market, right? Once you put it, so think of it as if you put in a limit order, you could be part of it, but if you put in a limit order and somebody, sells it to you on your limit order to buy, or buys it from you on your limit order to sell, you're already obligated to do that trade. It's not something that, you start negotiating. You're obligated to do that, execute that trade. So where were the dealer markets at that time? Well, keep in mind, there's also 7 potentially different markets, right? Because if it traded 7 different times, the markets could be different at each stage. But since we have a volume weighted average price of the trade, we could compare it to the volume weighted average price, I'm sorry, also give that same volume weighted to the bid and to the ask at that time, right? So most of this traded, where the market was 121, 128, bid 121, 128, then that's going to get more weight. So what do we see here is that at the time of these trades, this was the dealer markets weighted by the volume of the trade. So it was $1.21 to $1.28. And now we have these 3 numbers in front of us, and what can it help us learn, right? What kind of questions can this help us? Well, just looking at those 3 numbers, if the dealer quotes were $1.21 bid and $1.28 ask, if the trade was executed $1.27, it didn't exactly take the dealer quote. It didn't exactly, it's not right on there. It's a little bit off by penny. But it appears that the incoming order from just this information was to buy this put spread, right? That if it's trading closer to the dealer ask, right, that the incoming order is like paying up, right? Paying up to try to buy it. Okay, so this is an inference, but the inference is just looking at these three numbers here. All right. Then another question will be, okay, I see this $1.27. It traded at $1.27. However, these are derivatives, right? The options are derivatives, and what that means is that value of $1.27, it also depends on where the stock price was at that time. Because as the stock price is moving, these option values are changing. So what does that mean? $1.27. We need a reference price of where the stock was at. Was the stock, at 530 where it is now? Was the stock, look at the range yesterday, 521.84 to 531.29, right? So these options are going to move around with the stock. They have a delta. And, $1.27, it's also relative. Well, where was, was the stock at 521, where the put spread would be worth more than if the stock was higher at 530. So now we need another reference point, and that's the stock price. Okay, that's what we need to figure that out. What was the stock price at the time? Well, there were 7 different trades. It's not one trade, right? There's 7 different trades. So the stock price could have been at different different prices at each of these trades. It's possible. But because we have a volume weighted average price for the options, we could do the same thing for the reference price. Say, well, where was the stock price at each level, but we're going to give it a weighting. The stock reference price needs a weighting based on where the bulk of this volume is. And now we have this number, 526.70. So now we see that we see the trade, where it traded at, where the trade was relative to where the dealer markets were. And we see where the stock price was 526.70. So it was already low. It was lower than where the stock closed. Right. So in theory, this spread probably was worth less, right, than this $1.27. Because if put spread's worth less, if the stock goes up, it's worth more if the stock goes down. So let's take a look at this. I'm going to open this up. And now we have these details about this trade. So where was the last place this spread was marked? So keep in mind, when we look at options, it's not like a stock. So when we look at a stock price, this is a price that it traded at, right? So stock price, when we reference the value of a stock, we reference the last traded price, like last transacted price. But options are moving around. It's a derivative. So the value of the option changes based on where the stock price is going, even without a trade, right? An option itself will be valued based on where the stock is. It's a derivative. So we can't just reference the last traded price for an option. We have to reference where is the last value of that option, the market value, right? Where's the last market value of the option given this price, right? Because the price of an option could have traded in the morning. There was a trade, but then the market moved higher, the value changed, but there may have been no trade subsequent to that first trade. So where did these options get valued at the end of the day? Well, given this 530. Well, to create that value, we need to see what were the dealers or people willing to buy it at and sell it at. Because if they're willing to buy it at a price and sell it at a price, and those prices are firm, we could say that the value is somewhere between that. Because those are firm price, you could trade on those prices, right? You could trade on the bid, you could trade on the offer. So that's an actual mark-to-market value that we could reference. All right, so let's go down here and see if it traded at $1.27, and our assumption is it's worth less at the end of the day. Here's the current market: 105 bid, 110 offer. So you could see it was down, right? From 127, the value of that spread is lower because now the bid in it is 105, the ask is 110. So fair value somewhere, between 105 and 110. But we don't know what it is, so let's just call it the midpoint, like 107. That's the mark-to-market value. All right. And we could see the last traded price was 113 yesterday, VWAP 127. The low was 113, the high 128. And here are the 7 different trades. Right. So at 11:13, you could see 1, 2, 3, very big trade. It looks like, it traded on the ARCA and then the SIBO 2. And this is at 11:13. All of a sudden, 11:16, we see 3 minutes later, a 2-lot and 2-lot. I don't know, maybe that's a piggyback. Who knows? 11:33, another 20-lot. 2:53, another 2-lot. So those are kind of smaller trades. I don't know, what, but this one looks to me like, coming from the same source, 11:13, just how close they are together. And, they're very large. So that's the breakdown of the trades in this. And if we open this up, now we get some more details. These are details of each leg, bids and offers, implied volatilities. This is the open interest. So we could see that the open interest increased by 19,000 on the 501 put. So I'd have to see what else happened that day. But this just gives you a quick analysis of how the open interest changed, because keep in mind this was the trade happened yesterday, the open interest today. All right, well, we're right up at 9:30, so I think I'm going to just stop right there.
All right, perfect, D. Great job. One thing I haven't talked about all week, we have a webinar, excuse me, next week with Interactive Brokers, next Tuesday, correct, D?
Yep.
I think it's titled Navigated Scanning for All Things Calendar Spreads.
Yeah, yes, we're going to be talking about calendar spreads next week.
So that's Tuesday at 2, our monthly Interactive Brokers webinar. Again, we've said this a lot, but you have to go to their website to register for it, and you don't have to watch it live, but you go on the site, register, and they'll let you watch it whenever you want as well. So I'm putting that out there. Yep. Awesome job. Everyone have a great weekend. Thanks, D.
All right. Thanks, everyone. Have a great weekend and hope to see you guys